Dallas Fed President Robert Kaplan joins us. Good morning, Robert.
Steve, good morning.
I mean, it's just not great you're here on a day when the market's down 400. We got major questions about the outlook for the Fed, but you're also the guy to have because you're a former Goldman guy. So tell us about the message that you're getting from markets here, the recent sell-off, and especially the 210 spread, which is, I'm saying it's up a little bit this morning, but crazy that I'm saying it's up to 12 basis points between the two. What's the message of the markets, Robert?
Well, let me start with the 210 spread, and you've heard me say this, and I'd emphasize what I've been saying, that the short end of the curve is reacting to what the Fed has been saying. The longer end of the curve tells me that expectations of future growth are sluggish. And what I see in the stock market, and I obviously am a student and work with companies my entire career and a student of earnings reports, I'm seeing input costs are rising. Tariffs is a part of it, but it's not the only part of it. And companies many of them are struggling to pass on those cost increases to their customers, and you're seeing margin erosion. And we're also seeing some deceleration of expectations for next year's earnings growth, which off a high base. And so when you put all that together, I just think there's a lot more uncertainty, and it's very consistent with what I hear from companies I talk to and what we see in our surveys. And I think the implications for me and my job as a central banker, I think getting to 2 to 2.25, I've had a lot of confidence that we should be moving along. I think at this stage, you're going to hear me be much more cautious and counsel patience. I think there's more uncertainty. Global growth's decelerating. I'm seeing some interest rate sensitive sectors showing some weakness. It's too soon to say what to make of it, but I think this one of the key tools we have as central bank is patience, and I think we ought to be using that tool.
Robert, I want to give you some credit because you were talking back in mid-October about getting to the range of neutral before the leadership at the board was talking about the range of neutral. Are we at neutral now, possibly, or how far below it? And do you still think we need to get there? So
neutral is by its nature imprecise and uncertain, and you're not going to see it on your screen. And so I think the range at the FOMC and our longer run rate is somewhere between 2.5 to 3.5. I'm at the lower end of that range. And so my guess is we're probably a little bit below neutral, but we're approaching it. We'll know in hindsight where neutral was, but I think normalizing monetary policy was always going to be challenging. And I think we're in the stage of this process where you're going to hear me shorten up on the prognostications and be much more vigilant as to what's going on in the economy, but particularly not just the data, but what the outlook is and what the markets are saying about the outlook and what companies are saying. And right now, I'm just seeing a high level of uncertainty, and I think it's a factor in my thinking.
Robert, I got to be direct about this only because we're coming up quick on the meeting, and you guys are going to enter a blackout period where you won't talk at all. And I know one thing you don't want to happen is for the market to be mispriced going into the meeting. But here we are with a 76% probability of a rate hike in December. Is that too high?
You've talked to me enough to know I'm not going to comment on the market probabilities.
Go right at it, Robert.
And I would just say my own comment would be I think we ought to be very gradual and patient here. Inflation, in my judgment, isn't running away from us. The Dallas Trim Mean, which we just published over the last week, shows muted levels of inflation growth on core inflation, our reading of it. So I think we have the luxury of patience, and I'm not going to judge or predict what we're going to do in the December meeting. Obviously, I'll have a strong point of view going into that meeting, but I think we ought to be patient. There's a good possibility, and I'm very attuned to the possibility, if not the probability, that the economy is going to look very different in the first half of 2019 than it does today, because fiscal stimulus is waning, and we've raised rates 8 times over the last 2.5, 3 years. So I think all that means we ought to shorten up on our assessments and and be willing to be very patient.
Robert, we're all trying to make sense, especially this morning, of the relationship that the U.S. has with China. What's happening, whether the relationship is devolving, whether it's coming back. Obviously, we've seen swings even just over the past week. Take us inside the room, or at least take us inside your own thinking of how that's going to impact rates here in the U.S. and how the Fed thinks about it.
So there's two aspects I'd comment on in that regard. One is the trade tensions. And while headline GDP growth hasn't been affected by them, I can tell you firsthand companies are widely affected by these trade tensions. Either steel and aluminum or the retaliation back from the steel and aluminum tariffs and uncertainty created. 2/3 of the companies we survey, and we've got a very big corporate base in the state of Texas, tell us that either their input costs are already up because of it, or they're uncertain and it's having some chilling effect on their business decisions. So this relationship with China is part of that. The second part is China is a big percentage of global growth. And they're using more leverage to meet their 6.5% GDP target. So far, the U.S. economy has been outperforming the rest of the world. But we've got to keep in mind, eventually, if global growth slows, we're not going to be immune to that. And 45% of S&P 500, by the way, company revenues come from outside the United States. So it's not affected headline GDP growth here yet, but I think there's a decent chance you'll see it spill over into it if this goes on for long enough or intensifies.
Robert, could you hold on 1 second? I want to tell people what the ADP payroll numbers are. 179,000 ADP reporting for November. These are a day late because of the funeral yesterday. That's against an estimate of 190,000. October payrolls were revised, 225,000, just down 2,000, so that strong October number remains. Goods sectors up 16,000, services 16,000. 163,000. And there's the non-farm payroll estimate, so a little bit below it. I wouldn't expect any changes out there. And guys, just skip to the industry graphic here, and we'll just look at that real quick, if you don't mind. If you could get there. The education services, always a leader there. 49,000, leisure, hospitality, 26. Good growth across the spectrum. Construction up pretty strong. Manufacturing maybe a little bit lighter than it has been, but being on the positive side is still good. Can I get some guidance? Do we have time to go back to Robert Kaplan for one final question?
Yeah, go ahead.
Yeah.
Is that all right? Okay. Robert, I just want to ask you, Joe gave me permission.
Yeah, I did.
Who's running the show here?
Ask.
Robert, thanks for sticking around. First of all,
he knows who to ask.
Right, the jobs outlook is pretty good. The econ data's been pretty good. I mean, the ISMs were good. We get an ISM today on services. Is the worry, to use a craps metaphor, on the come here, or is the real worry right now in any of the data you're looking at? And could we get past this thing and all of a sudden the outlook is rosier back towards 3% growth?
Yeah. Well, our own forecast of the Dallas Fed is you'll see growth move down to 2 to 2.5 next year. I'm not predicting, and we're not predicting a recession. We're just saying the fiscal stimulus will fade somewhat. And back to the job growth number. Job growth numbers have been very strong, which tells me and tells us that there's been more women are entering into the workforce, and I think the data's shown high school and less. People are coming off disability. But the demographic trends in this country, the aging trends suggest workforce growth is going to slow. The big imponderable for next year is productivity growth going to jump more than we expect? But I'm a little skeptical about that. So I don't think it's going to be a bad year in 2019, but I think growth will be slower.
Right.
And I think these uncertainties we've talked about, we have to watch very carefully. Right. And that's why I'm just counseling patience as we assess all this information.
Robert, it's a credit to the Dallas economists at the Dallas Fed there that you knew months ago when we planned this, we were going to need you on today with the market down 400 and questions about the outlook for the Federal Reserve. Thanks for joining us.